Welcome everyone. Welcome to the March edition of From the Desk of Gordon Haave. I'm Gordon Haave. Glad you can be watching today. Now, what we're going to do here is we're going to go over a number of slides from last month's video. Why? Well, that's the framework that I'm operating in. And what we're going to do is we're going to look at those slides. Then I'm going to update what's going on with recent events, including the Russian and Ukraine war. Now, you might recall from last month I showed you this graph. What is it? Well, the red line is the S&P 500 from March of 2020 up through late last fall. And what does it show? It shows a massive increase in the S&P 500. This was due to the fiscal and monetary stimulus provided by the government and the Federal Reserve in response to COVID-19. Now, the black line is the S&P 500, the average S&P 500 increase off of the lows of a bear market, going all the way back to the 1960s. So there's been plenty of bear markets before. What usually happens when a bear market is exited? That's the black line. The red line is just what's happened since March of 2020. And you can see the rally was unprecedented, all right? Extraordinarily strong rally. Stocks going up. Now, I showed you this. Stocks tend to follow earnings, or I should say, projected forward earnings tend to lead actual earnings as they come in. So as I showed you last month, projected earnings are still strong. So actual earnings for S&P 500 companies should still be strong. But there's some storm clouds on the horizon, perhaps. U.S. industrial production year over year is now declining. All right, we don't have negative industrial production. What I'm saying is the increase is not as high as it was a year ago. So the incredible increase we'd seen in the economy is now slowing down. I showed you this graph, leading economic indicators. United States is in gray. Leading economic indicators went through the roof since the bottom in 2020, but they're now flat to declining. This is one of my favorite graphs, but I know it's also my most complicated. This is the global stimulus impulse. Well, what is it? It's a year-over-year measure again, and it's made up of two things. One, the credit impulse, which is the year-over-year change in new credit issued, that is how much lending banks are doing, as a percentage of GDP. And the other half of it is the fiscal impulse, which is the year-over-year change in government budget balances expressed as a percent of GDP. And what does this show you? This shows exactly what we've been talking about, which is in response to COVID, there was massive government and central bank intervention into the markets to try to prop the economy up. All right? That impulse is now negative on a year-over-year basis. It's not negative overall, it's negative on a year-over-year basis. So this storm of central bank and central government support and pushing the economy along after COVID is now declining. Governments and central banks are not doing as much to try to keep the economy going. So all this led to this graph I showed you last time. In red is the, in black is the S&P 500 off of the last bear market after the housing crisis. Phase one of the bull market looked just like phase one of this recent bull market, just straight up. But then we entered into a period of a phase two, a couple of years where it's still a bull market, but it's a lot choppier, and even one nice decline there in 2011. So we're in phase two of the bull market. So going back to this graph, strong leading economic indicators, even if they're flat to slightly declining. But due to this now negative year-over-year impulse, we have a decline in excess liquidity. Excess liquidity meaning all that cash the monetary authorities have pushed into the system. It raises a situation that doesn't happen very often, which is strong leading economic indicators, declining excess liquidity. So we take a look at other times this has happened. And if you look at other times when there's strong excess liquidity, while leading economic indicators remain high, what we see and what I've showed you is that value stocks tend to do very well. That's the red line. Profitable stocks tend to do very well. That's the gray line. Growth stocks, which of course is what everybody's been in so much for the last and done so well in for the last 10 or 12 years, they not to do quite as well. And if we drill down on that further, looking just within technology or growth stocks, we see in the black line, communication services stocks are basically flat, but infotech stocks tend to do quite negative, perform quite negatively after that point where leading economic indicators are still high, but excess liquidity goes down. And so that's why we concluded that we were in phase 2 of the bull market, which would be sideways and more volatile, that profitable and value companies were preferred, and that I was a little worried about tech, especially unprofitable tech. Now, everyone always wants to know about bonds. We are in a situation where the Federal Reserve has indicated that it's going to start raising interest rates. So what does that mean for bonds? Well, a lot of people think that once the Federal Reserve starts raising interest rates, that interest rates on bonds are necessarily going to keep rising as well. What we see in this graph, all right, and this is a graph of the last 3 rate hiking cycles, is that interest rates tend to go up in anticipation of Federal Reserve rate hikes, and then often go sideways or down once those rate hikes actually happen. So my position a month ago, which remains the same, is that we've seen the interest rate hikes in anticipation of Federal Reserve rate hikes, but we're probably in the clear. So I added on to the conclusion that bonds were okay here. Now, the big story that's been going on for a long time, which we discussed last month, is these competing problems, okay? There's inflation. Now, we've known there's inflation for a long time. I've been telling you that there's real inflation for a long time. For a long time, the government and the Federal Reserve said it was transitory. They're now recognizing that it's not. Inflation is a real risk for the political class. Inflation destroys political careers. Gerald Ford very likely would have won had he been able to do something about inflation. Jimmy Carter might very well have been able to win re-election had he been able to do something about inflation. But at the same time, one of the best ways to kill inflation is to raise interest rates. All right, that's what Paul Volcker did when Jimmy Carter named him to head the Federal Reserve. To combat inflation, he raised interest rates. It just didn't get done in time to save the Carter presidency. Raising interest rates can create a systematic risk. Look at this graph here. This is total U.S. debt as a percentage of GDP. And take a look at when Paul Volcker was chairman of the Federal Reserve in the late 1970s and early 1980s. We didn't have that much debt. But when Volcker raised interest rates, it still resulted in a crash in the economy in the early 1980s. A lot of you remember that. Take a look at the debt to GDP now. If you think raising interest rates to combat inflation created a recession in the early 80s, it did. What do you think is going to happen if they really raise interest rates to the level they need to in order to combat inflation, right? It's a systematic risk. It's a systematic problem. The whole financial system could be looking at a crash bigger than what was seen in 2008 and 2009. So what are they going to do? They don't want to crash the economy. They do want to preserve their electoral position. They need to do something. Well, that's why politicians and the Fed have been talking a lot about supply chain problems being the source of inflation. In my opinion, supply chain problems contribute to inflation, but they're not the main source of it. So I showed you this graph in the brown line being inflation, the blue line being the Baltic Dry Index, which is a measure of cargo ship rates. And the Baltic Dry Index was way down. And there's a lot of, I just pulled this one, there's a lot of indicators showing that at least prior to the war, supply chain problems were easing. So with supply chain problems easing, it had the potential to bring inflation down a little bit, even if I think higher inflation's here to stay. So I pondered last month, well, what if the Federal Reserve does raise rates a little bit? Bear in mind, they haven't yet, all right, because I still don't think they're serious about inflation. But what if they raise rates a little bit over the summer? And what if, due to an easing in supply chain problems, inflation fell from 7 to 5? Now, that's their numbers. I think inflation's higher. But inflation comes down a little. Well, that's a good story for the president, for Congress. Hey, they can blame inflation on supply chain and on COVID, and inflation's now coming down. Things are coming back. But there's also no systematic collapse from the Federal Reserve raising rates a little bit. So that's what I was thinking was basically going to happen. Now, by the way, what is it that could really collapse, cause a stock market collapse, the kind that would really affect your portfolios and your ability to stay retired or to retire? Looking at 3 major historical market tops for the past 100 years, what you usually see is sustained monetary policy tightening. We don't have that, all right? Despite the Federal Reserve saying that they're concerned about inflation and saying that it's going to raise interest rates, they in fact have not done it yet. And even this month, the Federal Reserve will be printing new money out of thin air and using it to buy bonds in the open market, which is certainly not monetary policy tightening. You typically see a clear divergence of surging bubble stocks versus the average stock moving sideways falling. Well, we did see that all last year. And you see collapsing leading economic indicators. We don't see that so far. I'm going to show you an updated leading economic indicator graph shortly. What in fact we'd seen is record high S&P 500 earnings, mostly good earnings reports. Fourth quarter GDP came in strong. We've seen a lot of CEO confidence and large share buybacks. Now, this was the total conclusions from last month. Phase 2 of bull market, market moving sideways, more volatile, profitable and value companies preferred, and worried about tech, especially unprofitable, bonds okay. So what's gone on since then? Well, first of all, since then, there's a lot of good news, all right? COVID is way down. It's way down both in cases and hospitalizations. And more importantly, in my view, where I live here in St. Louis, but everywhere I talk to, almost everywhere, it's largely over as far as a social phenomenon, if you want to call it that. Almost suddenly one day throughout most of the country, people have just stopped wearing masks, all right? And so there's a lot more mobility out there. There's a lot more people who are reluctant to enter the workforce, starting to enter the workforce. And we see that the employment numbers are great. The employment numbers that just came out are very strong. Now, I mentioned COVID, but one of the real big things, of course, is that the federal government has stopped supporting people not working. For a long time, we had the extended unemployment benefits, which kept people at home. And plus, we had the child tax care credit, which helped people stay at home. Now, whether you like these policies or not, I'm not here to debate. They're gone now. And a lot of support that people had for not re-entering the workforce is now gone. So what I think is going on is a lot of people who simply haven't been working are choosing to go back to work. That's ultimately good for the economy. This graph is one I follow. I think you'll find it interesting. The red line is U.S. building permits. It's a 3-month moving average. The gray bars are recessions. And what you see is prior to every single recession, building permits go down, and they tend to go down well in advance of recessions. We don't see that happening. Building permits remain strong. Furthermore, durable goods consumption in red is strong. The economy remains strong, and inventories are going up. Because of the strong durable goods consumption, all right, inventories need to be restocked. And on top of that, all these companies, which for the last 30 years have thought, well, inventory, who needs inventory, right? We'll just get stuff delivered every day when we need it. The supply chain problems have shown that maybe that wasn't a very good idea. So companies are building up larger bases of inventory. So a lot of data that the economy's strong, and we talked about some of this last month. But what else is going on? Well, the big thing that's going on is the Russia and Ukraine war. Now, I put out an email about 8 hours before the war started, and it concluded basically two things. A lot of people think, well, war's terrible, it's got to be bad for the economy. It turns out when the U.S. gets involved in wars, it's quite good for the stock market. Typically, when the U.S. gets involved with wars, the stock market goes down for a little bit, but ultimately it goes up. If you expand this to include major global problems that the U.S. is not involved with, you still see the same thing. You typically see a decline followed by a rise in the stock market later. Now, if you didn't see this email, contact your agent and take a look. Now, so what's happened since the war started? Well, the market's volatile. By the time you see this, the market might be up a little or down a little, but it's been up for quite a bit of it. And it's roughly flat as of this recording. But the problem is that inflation's an issue, and this is leading to higher inflation. We've all been talking for months about, well, is inflation really 10% instead of 7%? Is inflation transitory or is it permanent? I talked to you earlier about how, while I think inflation's here to stay, the government was hoping it would come down a little bit due to an easing of supply chain issues. Well, that's just totally blown out of the water with this war. Commodities are through the roof. Oil, wheat, everything. The fact is, we're going to see a lot more inflation now coming over the next few months. So that could impact Federal Reserve policy. It could impact fiscal policy. And more importantly, though, it's really starting to bite on consumer budgets. So if you take a look at gas prices in December, the December 31st data, that would have worked its way out to consumers on average, or the average household, spending $3,100 per year on gas for 2022. Well, guess what? All right. Through March 4th, gasoline futures are up 59% year to date. That means solely because of this war, consumers are looking at spending an extra $2,000 per year, per household this coming year. That's a lot of money. That's the kind of thing that can really erode at the economy in the long run. Told you I would update this graph for you, leading economic indicators. So already compared to a month ago, leading economic indicators are trending down. And this higher gasoline prices and everything else is going to make it all much, much worse. So this whole scenario I'd set up last month, that what they really wanted was hope that inflation comes down a little bit so that they have a good story that they're tackling inflation. And yet there wouldn't be any systematic collapse from raising interest rates too much. This story's now completely blown out of the water. Oil, wheat, everything's going up in price, and it's going to create real problems. So what I've always said is I'd get bearish when the Fed starts tightening aggressively and when leading indicators collapse. The Fed is not tightened aggressively. It's not tightened at all yet. The fact of the war might actually means that the Federal Reserve will do less tightening than it's even indicated. Leading indicators are going down. That's not a collapse. The economy overall is still humming along all right. People are getting back into the workforce. What the Ukraine-Russia situation does tell me, though, is that this could be coming sooner than expected, all right? due to the hits to consumer pocketbooks, leading economic indicators might start collapsing. The Federal Reserve is not tightening aggressively yet. The war might even cause it not to tighten aggressively, but rising inflation may force its hand sooner rather than later, i.e. before the election, even though they would not like to do it before the election. So the summation of all this is it's got me a little more worried. We're still monitoring this. Hopefully that the war resolves itself for the sake of everyone. Hopefully these commodity prices come back down and the economy keeps chugging along, but we're starting to get a little bit concerned about it. Now, what you can do is you can contact your representative, get in, make sure you have a plan, make sure you're prepared for these eventualities, and most importantly, think about your taxes in retirement. If there's one thing I'm pretty certain of, given all of the fiscal situation of our government, is that taxes are going to be going up in the future. If you have the opportunity to be thinking about some things like Roth conversions, now might be a good time to do it. That's it for this month. Thanks very much, and I'll see you next month. Thank you.